There's a specific dollar amount sitting in your bank account right now that's costing you thousands of dollars every year, and most people have no idea it's happening. You think your money is safe, just sitting there waiting for when you need it. But the truth is, every dollar above a certain threshold that you keep in a regular checking or savings account is actively making you poorer. Not in some theoretical future sense, but right now, every single day. And the banks? They're laughing all the way to their own vaults because they're profiting enormously from your financial ignorance. The question isn't whether you should keep some cash accessible. You absolutely should. The question is how much, where to keep it, and what happens to every dollar beyond that optimal amount. Get this wrong and you could be throwing away 5 figures annually in lost returns and opportunity cost. Get it right and you'll optimize your cash position to provide security while not sacrificing returns. Let me show you exactly where that threshold is and why keeping more than this specific amount in a bank is one of the costliest mistakes you can make. Let's start with what you actually need and readily accessible cash at a traditional bank. This is your operating money, the cash you use for daily transactions, monthly bills, and immediate expenses. For most people, this is somewhere between 1 to 2 months of expenses. If your monthly expenses are $5,000, you need $5,000 to $10,000 in your checking account to handle bills, purchases, and normal cash flow. This money needs to be immediately accessible through debit cards, checks, and electronic transfers. There's no way around keeping this amount in a standard checking account because you need instant liquidity for daily life. But here's where people make the first massive mistake. They keep 3 months, 6 months, even a year or more of expenses sitting in regular checking or savings accounts, earning essentially nothing. The national average interest rate on savings accounts is currently around 0.46%, less than half of 1% annually. If you have $50,000 sitting in a traditional savings account, you're earning about $230 per year in interest. Meanwhile, inflation is running at 3 to 4%, which means your $50,000 is losing $1,500 to $2,000 in purchasing power annually. You're going backwards by $1,200 to $1,700 per year, just from inflation eroding your cash that's earning almost nothing. But wait, it gets worse. That $50,000 could be earning 4% to 5% in a high-yield savings account at an online bank. At 4.5%, $50,000 earns $2,250 annually. By keeping your money in a traditional bank earning 0.46%, instead of moving it to a high-yield account earning 4.5%, you're leaving $2,000 per year on the table. That's $2,000 annually that you're essentially gifting to your bank for absolutely no reason. Over a decade, that's $20,000 in lost interest earnings, plus the compound growth you would have earned on that interest. You've given away enough money to fund a nice vacation, a car down payment, or a significant portion of a child's college education, all because you were too lazy or uninformed to move money to a better account. So here's the threshold. Never keep more than 2 months of expenses in a traditional checking account. That's the absolute maximum. 1 month is probably optimal for most people. Everything beyond that should be moved to higher-yielding alternatives immediately. If your monthly expenses are $5,000, you should have no more than $10,000 in checking, and ideally just $5,000. Everything else, your emergency fund, your opportunity fund, your savings for major purchases, all of it should be somewhere that pays you actual interest rather than the insulting rates that traditional banks offer. But high-yield savings accounts are just the start. Let's talk about FDIC insurance limits, because this is where keeping too much cash in a single bank becomes not just costly, but actually risky. The Federal Deposit Insurance Corporation insures deposits up to $250,000 per depositor, per bank, per account category. This means if you have $300,000 in a single bank and that bank fails, you could lose $50,000. It's gone, not accessible, lost in the bank failure. This actually happens. Banks fail and depositors with more than the FDIC limit lose money. If you have more than $250,000 in cash that needs to remain liquid, you need to spread it across multiple banks to stay within FDIC insurance limits at each institution. Having $300,000 in savings, put $150,000 in Bank A and $150,000 in Bank B. Both amounts are fully insured. Or if you're married, you can double the coverage at a single bank by having money in individual accounts plus a joint account, which provides separate insurance coverage. The point is, if you're keeping more than $250,000 at a single institution in your name, you're taking unnecessary risk with amounts above the insurance limit. But here's where we need to talk about the opportunity cost that makes keeping large amounts in cash so devastating. Every dollar sitting in a savings account earning 4% could be invested in the stock market, where historical average returns are around 10% annually. That 6% difference is enormous when compounded over time. Let's say you have $100,000 that you don't need for emergencies or near-term purchases. It's just sitting in savings earning 4%. Over 20 years, that $100,000 grows to about $220,000. Not bad. But if you'd invested that $100,000 in a diversified stock portfolio earning 10% annually, it grows to $670,000 over the same 20 years. You gave up $450,000 in growth by playing it too safe and keeping money in cash that should have been invested. This is where we need to distinguish between different buckets of cash and what belongs where. Your emergency fund, which should be 3 to 6 months of expenses, belongs in a high-yield savings account. Not checking, not traditional savings, but high-yield savings at an online bank paying 4 to 5%. This money is for emergencies only. Job loss, medical crisis, major unexpected expenses. It needs to be completely liquid and accessible within a day or two. High-yield savings provides this liquidity while actually earning a real return that at least partially keeps pace with inflation. Your opportunity fund, if you maintain one, should probably be in short-term treasury bills or a money market fund. This is money you're keeping liquid to capitalize on opportunities like market crashes, real estate deals, or business investments. You want this money accessible within a few days, but you can tolerate a tiny bit less liquidity than emergency funds in exchange for slightly better returns. Treasury bills are currently yielding around 5% and are backed by the full faith and credit of the U.S. government. Money market funds are yielding similar rates and provide same-day or next-day access to cash. Both are better options than letting large amounts sit in even high-yield savings accounts. Anything beyond your emergency fund, opportunity fund, and monthly operating cash should not be in cash at all. It should be invested in retirement accounts, taxable brokerage accounts, real estate, or other assets that actually grow wealth over time. Keeping more than 1 year of expenses in cash is almost never optimal unless you're in a very specific situation, like preparing to buy a house within the next few months or facing a known large expense. Let me give you specific numbers for what you should have where. If your monthly expenses are $5,000, here's the optimal allocation. $5,000 in checking for daily operations, $25,000 to $30,000 in high-yield savings as your emergency fund covering 5 to 6 months, another $25,000 in treasury bills or money market fund as an opportunity fund if you want that flexibility. That's a total of $55,000 to $60,000 in cash and cash equivalents. Everything beyond that should be invested unless you have a specific reason for keeping it liquid. If you've got $100,000 or more sitting in bank accounts beyond these amounts, you're making a costly mistake. That extra $40,000 to $50,000 should be in your 401k, IRA, or taxable brokerage account invested in diversified index funds. At 10% average annual returns, that $40,000 becomes over $260,000 in 20 years. Keep it in cash earning 4% and it becomes only $88,000. You've cost yourself $170,000 in wealth by keeping money in cash that should have been invested.
Now let's talk about the psychological trap that keeps people holding too much cash. It feels safe. Having $100,000 in savings feels more secure than having $30,000 in savings and $70,000 in investments that fluctuate in value. When you check your bank account and see 6 figures, there's a comfort to that number. It's concrete, stable, and always there. But this psychological comfort is costing you enormous amounts of money. You're paying tens or hundreds of thousands of dollars over your lifetime for the feeling of safety that comes from seeing large cash balances. The people who build significant wealth understand that cash beyond your operating and emergency needs is a drag on returns. They keep exactly as much cash as necessary for security and liquidity, and they invest everything else. They're comfortable with market volatility because they know that over long time periods, investments dramatically outperform cash. They've trained themselves to feel secure based on their net worth and financial plan, not based on how much cash is sitting in checking accounts. Here's a framework to break the psychological attachment to excess cash. Calculate your true emergency fund need based on your monthly expenses and income stability. If you have a stable job with good benefits, 3 months might be sufficient. If you're self-employed or have variable income, 6 months makes sense. Put this amount in high-yield savings and mentally label it "Do Not Touch" except for genuine emergencies. Calculate your monthly operating need, probably 1 to 2 months of expenses, and keep that in checking. Everything else gets invested according to your financial plan and goals. When you have this structure in place, you can stop worrying about having large cash balances because you know you're covered for emergencies and you've optimized the rest for growth. The specific dollar threshold varies by individual circumstances, but here's the general rule. Never keep more than $50,000 sitting in banks beyond your emergency fund and operating cash unless you're actively saving for a major purchase within the next 12 months. If you're saving for a house down payment and you plan to buy in 6 months, sure, keep that money liquid in high-yield savings or treasury bills. But if you have no specific near-term use for the money, having more than $50,000 beyond your emergency fund sitting in cash is almost certainly a mistake. Let me give you some real examples of how costly this mistake becomes. Person A keeps $150,000 in bank accounts. $50,000 is their emergency fund, $5,000 is operating cash, and $95,000 is just sitting there because it feels comfortable. They earn 4% on this money, about $3,800 annually after tax. Person B keeps the same $55,000 in cash for emergencies and operations, but invests the extra $95,000 in a diversified portfolio earning 10% annually. They earn about $9,500 annually on that invested money. The difference is $5,700 per year. Over 20 years, the difference in outcomes is staggering. Person A has about $208,000 from their $95,000. Person B has about $638,000. That's $430,000 difference, all from the decision to invest instead of holding excess cash. The numbers get even more dramatic when you factor in that Person B is probably adding to their investments over time, while Person A is probably just maintaining the same cash balance. After 20 years, Person A still has $150,000 in the bank, adjusted for whatever they added or spent. Person B has built substantial wealth through consistent investing. The gap between their net worths is likely over $500,000, entirely due to Person A's mistake of holding too much cash. Now let's address some objections and special circumstances. What if you're planning to retire soon and you need cash for living expenses? You should have 1 to 2 years of expenses in cash and short-term bonds, but not more than that. The rest should remain invested in a balanced portfolio appropriate for your risk tolerance and timeline. What if you're saving for a house down payment? Keep that money in high-yield savings or short-term treasury bills, but don't let it sit there for years. If you're not buying within the next 2 years, you should probably be investing at least some of it. What if you're worried about a market crash? Having adequate emergency funds protects you from needing to sell investments during crashes. Beyond that, trying to time markets by holding excess cash usually results in missing growth while waiting for a crash that may not come for years. The only people who should consider keeping more than $50,000 to $70,000 in cash beyond emergency funds are those with very specific circumstances. Someone about to make a large purchase within 6 months. Someone transitioning between jobs and needing extra cushion. Someone elderly who can't afford any market volatility. Someone starting a business and needing accessible capital. But even in these cases, the excess cash should be temporary and should be deployed as soon as the specific need is addressed. Here's the action plan if you currently have too much cash sitting in banks. First, calculate your actual monthly expenses and determine your emergency fund target, probably 3 to 6 months. Second, move that emergency fund to a high-yield savings account at an online bank currently paying 4 to 5%. Third, keep only 1 to 2 months of expenses in your checking account for operations. Fourth, take everything else and deploy it according to your financial plan. Max out retirement accounts first, then taxable investment accounts. If you're debt averse, pay down mortgages or other debts. But get that excess cash working for you instead of sitting stagnant. The bottom line is this: keeping more than $50,000 to $70,000 total in bank accounts beyond what you need for monthly operations and genuine emergencies is a costly mistake that's robbing you of wealth. The opportunity cost of excess cash is enormous when compounded over decades. The banks are profiting from your excess deposits while paying you almost nothing. Meanwhile, you're missing out on investment returns that could build substantial wealth.
Optimize your cash position by keeping enough for security and liquidity, then invest the rest. Your future self will thank you when you're looking at hundreds of thousands in additional wealth that you built by not making the costly mistake of keeping too much cash in the bank.